Hey, good morning, everyone. Marty Mazzora here, May 9th, 2020, Saturday morning. This is going to be your macro update and a bit more. I'm going to try to be swift for you this morning, as I always try to be. As you've noticed, I don't always succeed with brevity when it comes to these videos, but I'm going to give it a shot today. Folks, there's a lot to talk about, more than we have time to do on a video together this morning for sure. I was just thinking about what supplemental information, supplemental to our macro presentation, I wanted to add this morning. Spending a lot of time getting my head around COVID testing, new antigen test news this morning, the prospects for a vaccine from multiple different companies, the timing of that, what it all means economically, what the surveys are saying about people and their feelings in terms of re-engaging in the economy, my own observations, asking every client in every review and everyone I come in contact with, which isn't very many people these days, what's your experience been? How are you feeling about getting back out? Would you book a cruise tomorrow? What do you think your friends are thinking? Those kinds of questions. Those are really important when we think about the economy and the markets and so on. We'll talk about, of course, the economy and the markets and about the narrative that always pops up. I keep hearing this from the interviews that I listen to. There are a few people, a few analysts, a few economists who are worth listening to because their views change as conditions evolve. The ones who are always on one side, either bullish or bearish, should be dismissed out of hand normally. I can't say they don't have some studies that ultimately make some sense and that I won't look at those. But in terms of just deep thinkers who aren't wedded to either side of the market possibilities, again, those who just aren't perpetually bullish. There's lots of those out there. They make some interesting cases for why the market is where it is. And then there's the ones who are perpetually bearish, who even when all of our data and indicators say we should be screamingly bullish, they will always find reasons to be bearish. Our task, my task, is to not be either one of those personalities, to always look as deep into the woods as I can to uncover the key data, key trends, look for new things that I haven't thought about before, and just get my head around what are the probabilities? What is the risk reward setup? What should we be doing within client portfolios? To what degree should we be hedging? Should we be a bit overhedged because of conditions? Should we be underhedged? And so on. So let's get started. So what you have in front of you is, of course, our index, something we created back in the summer of 2017. I'll just run through this quickly. Here we were when we started our index, nice upward trend, very, very bullish setup back in here, highest ever on a real-time basis. And then we began to roll over. I showed you a chart the other day. The bond market began to roll over about right here. And of course, the bond market would be an indicator of economic conditions, although we didn't begin to hedge portfolios until right in here, the summer of 2019. And right in here toward the end of the year, we went from simply hedging with an options collar to actually really changing the portfolios into something more defensive and then implementing a new hedge with options, which is what we're doing currently. Notice we actually got an uptick, first one in a long time, many weeks. It's not obviously long ways from positive, that's the zero line. But the uptick was one data point, the staples to discretionary stocks ratio. So consumer staples, stuff you got to buy even during a recession. Consumer discretionary stocks, things you only buy when you have extra money. That could be an indication, at least a market indication of the state of the economy. As the market has come back now, discretionary stocks are down less than staple stocks on a year-to-date basis. So they're outperforming, so our ratio is going in the other direction. So that turned green. That's a bullish sign for the economy. Obviously, there's a lot of other bullish signs that will need to show up, and we'll need to start seeing a definable trend in the other direction before we dream of getting growthy again. But we look at every data point, score it objectively, and then it has an impact on our index. So obviously there's a lot going on that's not so good to have a score that's still negative 74. But I'll take any green shoot I can get at this point. So what I'm going to do is run through several data points and then get to market sentiment and then some market technicals for you. None of this should come as a surprise. It should be shocking to see these kinds of data points, but it shouldn't be a surprise knowing what we all know about the economy. Auto sales worse than the last recession, which was the worst recession since the Great Depression. On a rate of change basis, very critical to our analysis. That's about as ugly as it can get. Consumer credit off a cliff. Now, during expansion, higher consumer credit actually is bullish, and we score that very positively. As we get toward recession conditions and we see consumer debt begin to pick up, suddenly when this would be a bullish condition coming out of a recession, suddenly it's not so bullish. And then this just basically confirms, which we already know, and that's that the consumer has some serious challenges that he or she is presently facing and probably will continue to face going forward. Manufacturing new orders or factory orders, showed you this the other day, unbelievable. Purchasing Managers Index, a company called Markit, M-A-R-K-I-T, does this, and they do it globally. I appreciate the work they do. It's not, we don't have a long history of it, but 26.7 was the services sector reading. 50 is the dividing line between expansion and contraction. So never seen anything like this in the history of this index, of course. The Institute for Supply Management, the one that's in our index for services, 41.8, a little better still than the Great Recession. We'll see. Unbelievable in terms of the rate of change there. Weekly jobless claims, better, and please don't take better for how it sounds. 3.169 million is unbelievable, but it's off of the almost 7 million from 2 weeks ago. Continuing claims, people who are still on unemployment, that continues to rise, and that is 22.6 million Americans. Again, these are numbers that in my wildest dreams I never thought I'd see. Job cuts. Challenger does a monthly survey, who's lost their jobs. That's the definition of a record. ADP, private payrolls, the payroll company does their own survey, as you can see. Huge decline, just kind of off the charts here as of last Wednesday. The non-farm payrolls, that'll be 2 months worth. This is March, and this is March dropping to more than the worst month that we saw in 2008. And when you look at yesterday's number, this is what happens to the graph, because this is just something that's just out of this world. I mentioned in a blog post yesterday morning that, of course, the market went up 400 points. We'll talk about that in a minute, or the Dow did. That 18 million of these people reported that they are temporarily laid off because of coronavirus. That was one of the positives, if you can call it that. But remember what we have left, 2.5 million people who believe they have lost their jobs for a longer period of time. And then as the economy relates to the stock market, this narrative that the stock market is not the economy is not the stock market. Whenever I hear that, I just think, that's just not the case. The economy, of course, is not the stock market. They're two different things. But yes, ultimately, the stock market does reflect the economy. Here, let's say this. This is a stock market following corporate earnings, okay? This is a stock market that is following the Fed, and this is a stock market made up of folks who got used to buying all of the dips for the last 11, 12 years. And when the Fed engaged right here, it was a good thing. When the Fed engaged right here, it was a good thing. When the Fed engaged right in here, it was a good thing. So this happened, it's a dip, and the Fed's engaged. Is it a good thing? Well, that's what the market's discounting. Is it a good thing when this happens? not historically. This story is yet to completely play out, but folks, if we aren't careful right here, we are being the definition of foolhardy. So getting to sentiment, the market is holding up nicely, no doubt about it. And really what's helping, in my view, to a large degree is sentiment. The American Association of Individual Investors bearish reading, the respondents who feel that the market's going to fall apart over the next 6 months, 52.58 is hugely bearish. Okay, that's hugely bullish for the stock market, because when folks are hugely bearish, they're sitting hugely on cash. And if the market takes off without them, they might fear that they're missing out and need to chase it. And when they chase it, things get better. So folks who are either believing in sentiment indicators, and I'm going to give you some more history here on that in a second, or folks who are, and the big story lately is the Robinhood brokerage firm that does commission-free trading that apparently a great majority of millennial traders trade on. In fact, crazy statistics here recently. When Warren Buffett said he abandoned airlines, the next day, the number of Robinhood accounts in the ETF jets, which follows the airline industry, and in the airlines themselves, went from a few hundred accounts holding those stocks to tens of thousands of accounts holding those stocks. Isn't that fascinating? One of history's greatest investors, who still sounds very sharp at age 89, says he's abandoned something, creates a big dip in that something, and the world comes and buys it. Sounds to me eerily, or feels to me eerily, like the dot-com bubble in 1999, when young people quit their jobs, cashed out their 401ks, became day traders, and thought they were all going to become multimillionaires, until the market ultimately sucked enough of them in and then sadly spit them all out and left many of them broke and starting over. I'm not predicting that that's going to happen, but that element feels like it's there when you start looking at these statistics in these Robinhood accounts. So I'm gonna circle back to this with a live chart, because I want to show you a little bit more history on this. The investor intelligence. Advisors, you want to go against them as well. Everyone but yours truly, of course. I'm smiling. The fifth straight gain this last week for the bulls. Okay, so the bulls are picking up. That's actually bearish, right? If you have a lot of bulls, they're in the market, they're optimistic. They get scared out, they all get scared at once, they all sell, you get a precipitous fall, right? Bulls above 55% calls for defensive measures. So we're not there yet, but we got all the way down to 30.1% when the market bottomed out in March. Okay, that was bullish because we had fewer bulls. Now we have more bulls. The bears, right, those who think the market's going to fall apart among investment advisors, dropped to 26.9%. Get below 20 and that becomes not a favorable situation for longs, people who are betting that the market's going to rise. So I record the bull-bear spread. It's part of our financial markets index, and it's at 21.2%, up from 17.5. You get defensive when it's above 40. So folks, in terms of the advisor sentiment, it's getting a little more bearish, but it's not super bearish at this point. And this is helping this market, not having a bunch of bulls in it, right? That's a positive thing, because again, when there's more bearish people on that side of the boat, they can run to the bull side of the boat and help keep this market elevated. Now, the thing that I've been pointing to a lot lately, because this really explains a lot of these big moves, like yesterday, I think the Dow was up 400 and so on points. This is the net interest, the net positioning of futures traders that speculate on S&P 500 contracts, or the S&P 500 in the futures market. So folks, again, I've said this before, you need to know what you're doing. It's very risky. You got to be sophisticated to be able to play the futures and do it right. These people have been betting a lot on the market falling apart, the market coming down. Now, when you're short, you borrow shares, you sell them, you hold on to the cash. You've got to pay back the shares, not cash, but the shares. So you have to buy them back. So what these people are counting on is the market really falling apart after they've sold the shares, buy them back, at a much, much lower price, give them back to the lender, and pocket the difference. It's a way to make a lot of money when you're right. But when you're wrong and the market goes against you, remember, you ultimately have to pay those shares back. So when it starts going up, you could end up spending a lot more buying them back than what you have in your account after selling them. Being smart enough to know how to trade futures, assuming they know what they're doing, they are going to cover to protect themselves. Covering means buying. Buying those shares when you have this much short interest is really going to do a number to the upside and enhance, particularly in a low volume market. I'm going to show you that as well. So folks, some of these big moves have to do not with something you should be optimistic about, not with this notion that we're going to reopen the economy and we're going to be off to the races. I sure hope so. Make no mistake. I'm just trying to be realistic here. But it has to do with people panicking and buying, believe it or not. Another what I keep looking for here is for this to go away. But what's happening is they're going short, they're covering, and they're pushing the market higher. And just as the market begins to lose momentum, I'm certain they're just circling back around and they're reestablishing those short positions because they have full faith that this thing is going to roll over and come crashing down. Now, those of you who read my blogs every day, you might think I have that full faith as well. I don't have full faith in anything that relates to the market. The only thing I have full faith in, frankly, is our analysis. And the best our analysis can do is measure conditions, probabilities, and risk and reward. My experience has been that as long as we are investing in a nature consistent with those things, the probabilities as we assess them, the risk-reward setup, we will look pretty stupid at times when the market goes against our overall assessment. We're not going to be in a position where we're going to get demolished in such a situation if the market goes against our assessment because we're humble and we know that in the near term we could be dead wrong. In the long term, chances are, as long as we do our work and we do it well, we're going to be pretty good at probabilities. And most importantly, frankly, particularly during times like these, we have to be very good at protecting our clients against big drawdowns and be willing to be in a position that mutes our results when the market goes against us. And that's okay, as long as we continue to invest along the lines of probabilities. When we get to a point where conditions, the risk reward, probabilities suggest that for real, this market has a legitimately more upside in a big way versus downside, then of course the complexion of the portfolios are going to look different than they do today. So again, here's the bearishness among individual investors. Here's that short interest that I just showed you among futures traders, okay? So bulls kind of have the best of both worlds. You've got scared individuals with a lot of cash. You have opportunistic futures traders that are very short who would cover if these guys get bullish and help out even more on the upside. So is that a certainty? Is this something that we should bet a lot of money on a short-term basis, that these two combined, meaning that stocks go higher? It certainly helps on the short-term probabilities that stocks are going to go higher, but let's take a look back at, just for one example, the last big recession/bear market. Okay, so here's the 2008 bear market, and by the way, this does not do justice to the depth. From here to here, it was a 57% decline. Now, here is the bearishness among individual investors. Now, the white line is where they are now. This is where they were then back in November of 2007. More bearish, more concerned. These guys are pretty close to where they are now, I believe. Yeah, this is, of course, the scale is different because of I'm stretching it out. But look, the market bounced, but then it came down a bunch. Okay? Right in here, these guys went bullish on net, and that was ultimately probably bearish for the market. They changed their mind. Now, these guys got bullish, and the market, kind of stayed around. So not a whole lot here. I bet a lot of sentiment watchers got real excited about things in here. Here we are with net short interest, notably. Huge bearishness on the part of individual investors. And yeah, the market kept going, so that made some sense as well. Then we get in here July of 2008, huge bearishness, real short interest, and then the market rolled over here. Huge bearishness, right? Real short interest for sure, and then kaboom, big, big, big decline in stocks. So what I just showed you, and of course, this is a different scale, so it's not quite as dramatic looking, but that's real net short interest. So here's where you had that combination that I just showed you that, sentiment watchers would be bullish about. Well, it didn't work out that time. We had the worst of the 2008 bear market happen right in here. And then notice here, though, when we bottom, now you've got something, serious. You've got huge bearishness, right? But you've got bullishness here on the part of the futures traders. And that happened to be right where the market ultimately bottomed. And then these guys, came off of that and started buying stocks and so forth. So that ended up being positive. They ended up being right in this circumstance, and essentially we're off to the races. So folks, that's why we look at so many different things. Sentiment is key. I'll continue to show you that. Certainly on a short-term basis with this short covering, it does explain a lot, and I mean a whole lot, having to do with these big rallies that we've been having. Okay, so I want to take a look at volume with you for a minute. Every day I record a whole lot of market internals, statistics. Sometimes I share those with you on the blog. A few times lately I've been talking about the volume on these big up days just not being inspiring, and sure enough, Friday was another one of those. So again, using the Dow because that's what everybody thinks of, 400 and some odd point rally, big rally, right? Well, S&P 500, had a big rally as well. This is the volume relative to the 20-day average, down 17%. Folks, these are not bull market days. I don't know that I've seen just one or two throughout this whole time. Very few, I can count them on one hand for sure, where we actually had average or above average volume. In fact, I'll give you some history of what's been happening lately, on an extended period basis. But the volume itself is uninspiring. And then over here is where I get that data that I write about on the indexes. So when you look at Friday, for example, utilities actually had the highest degree of volume, and it was 17% above average. Very concentrated again, second day in a row with CNP, which is Centerpoint Energy, 148% above average volume. It was 350 the day before, and the stock was up another 4.38%. So this gives us the biggest movers relative to the average in terms of their volume, right? EXC, Exelon was volume 47% above average, and the stock was up 7%. So utilities had a pretty good day. In fact, they were up over 2% on the day. Now, of course, utilities are not a growthy sector. Utilities are a defensive sector. So utilities having above average volume on a big up day doesn't speak very optimistically about the quality if you're a bull and you're looking for this thing to turn around. Now, in terms of lowest volume, that happened in the energy space. That was the lowest volume on the day. And energy was the biggest winner, up 4.6%. Marathon Oil was up 5%, and it had volume 30% below average. So my point here, folks, is that when you're up 4.5% in a day, if that's an industry you like, and there's 30% less than average volume, all that means is that a few number of buyers coming, and basically the sellers are saying, bid it higher and I'll give it to you. But certainly not a big wave, a big rush of investors coming into the energy sector. In fact, again, quite the opposite. So those are important things to look at just to gauge sentiment. Now, if I started seeing key change in that trend, and I started seeing, hey, we're getting better volume, we're getting it in the growthy sectors, the breadth is good, there's less concentration, the market is telling me something that I may not be seeing in the other indicators. We need to dig deeper, and we need to find out if this is for real or develop a thesis around it. And if so, maybe we need to lighten up on some of the hedges, get a little more growthy in some of the allocations, or or continue to wait and see. Just not getting that, folks. So again, it's not that I want to be bearish. Clearly, that's how I'm sounding on the blog. This is all quantified by all of this data, and I take too long to share all of it with you because, of course, I have a tendency to ramble as I get going on this stuff. Okay, one more on volume. So I showed you the daily volume. Now let's take a look at it on a trend basis. So here is the S&P 500. Here it is falling apart around the 20th of February, bottoming just a few weeks later, March 23rd. And this is the volume chart. These are the daily volumes. This is what we're dissecting at the end of every day. This is the 10-day moving average, just to smooths out the bar to give us kind of the trend, right? I've shared this with you before. You know, when the market was going up, I was looking for gaps here, looking for some risk, and just basically looking for conviction. Well, as the market fell, of course, we know a lot of people panicked, so we had huge conviction, right? As the market has been rising, anything but the sort, and it's just getting worse and worse and worse as we go. Okay, so this is a very bearish sentiment indicator. This is saying that the commitments, any passion whatsoever around this particular rally is really beginning to wane. Doesn't mean that we couldn't get some news. Doesn't mean that something really bullish can't happen and suddenly this spikes in the other direction. I'm just talking about the trend. This is losing conviction in a hurry. There's no doubt about it. It's just not a bullish sign. Doesn't mean that we can't be bullish, as I just said, to repeat myself. It just means this is how the trend looks so far. In the futures market, literally we had double the daily volume on the way down than we have on the way up, or you could say half the volume as we've come screaming back up versus when we went screaming down. So again, that was so precipitous, I would expect somewhat less volume, but this is pretty dramatic. This is something that should have red flags up for those of us who are paying attention. Okay, lastly, I think, this is, in terms of long-term momentum, your 200-day moving average is the blue line, the S&P 500 is the white line. I'm taking you way back to the late 70s, and the red shaded areas, as always, are recessions. So with the 200-day moving average, people get excited when the price drops below. I would get excited when the price drops below and the 200-day moving average rolls over, and I have a negative macro score in my own assessment. So here we are rolling over, and here you notice the market came back. It tested the 200-day moving average, and lots of technicians pay attention to this, and it failed. Really negative sign. Here it came up, almost tested it again, and failed. And notice we have a downward sloping 200-day moving average. Failed, failed, failed 3 times. Came up in mid-1982. Came out of it. If I were just living on this technical indicator, once that began to slope higher, that's when I'd begin to get bullish again. So you'd wait for that to happen. Okay, you'll see why in a minute. Not a bear market in here, but you can see it came down, began to roll over. What did we not have? We didn't have a recession. We didn't have recessionary conditions. My observation, my experience, and my analysis over a century of history tells me that to really get worried about the market over a long-term basis, pay attention to the macro. You're looking for recessions. So flipping forward a little bit, we have the 85 to 95 period. This was bad. Contradicts what I just said, doesn't it? Because we didn't have a recession in 87, but we did have a crazy sell-off. This all right here was one day. It was Black Monday. Believe it or not, I remember it. Not like it was yesterday, but boy, do I remember that. We came out of it in a hurry. Of course, the 200-day moving average rolled over, and we came off of that. There was interesting dynamics. I could probably do another video on my view of what happened there. It had to do with derivatives, had to do with positioning, liquidation events, kind of like we just had, and so on and so forth. But we didn't have a recession. We were still in expansion. You can see we did come out of it. It took a while to get back to those levels. So this is a 1990 recession that really didn't actually bring a bear market. We did begin to roll over right in here. And believe me, if I was testing my index back in here, we would have got defensive, no doubt about it. And then we would have had to get back to offense relatively quickly as we came up through here. And right in here typically is where we begin getting better in terms of our macro analysis. And then so here we are, an upward sloping trend line, and then the beginnings of the longest bull market and the longest expansion ever until the last one that recently ended. So the market testing that 200-day moving average. You had this was a bond bear market in here, but not one for stock. And then were we off to the races for the last part of that bull market. And then we had the tech bubble, right? Then we had the tech bubble burst up in here. Market actually peaked back in April of 2000. We talk about these retracements. Dip retraced virtually all of it, right? And then came down, broke through the 200-day moving average. It rolled over, tested it, not quite tested it. We'll call that a test. Kept coming back, kept losing it right at that 200-day moving average. And then finally just really fell out of bed for, call it a 50% decline before it was all said and done. And then here we have a higher low, right? And then we have breaking through the 200-day moving average with momentum, quickly begins to slope higher right in here, if not sooner. You want to be re-engaging. Then the big one, greatest recession since the Great Depression. That's why that's such a fat red area right there. So rolled over back up here in the fall of 2007. That's where we peaked. Playing around, or struggling with that 200-day moving average. It began to roll over here. We came down, retraced half of this decline right in here, but hit that 200-day moving average. That was pretty much it. That was really our only, up in here and then right here were our tests. Came back, and then of course everything fell apart. Call it a 57% decline. Came up back in here, broke through with some momentum, slopes up, and then a record-breaking, longest ever bull market and expansion in history. The 10 years leading up to where we are today. So this was the European debt crisis. Looked like we were going to roll over. This was almost a 20% decline, like 19.5 or even more than that. So it wasn't defined as a bear market. Came out of it, didn't quite get that big downward slope here. We've gone through this analysis before, but we were still green, albeit barely, in our index back in here. So we would not have reacted to this correction in here. We absolutely did not react to this one in here. We actually had a better macro setup, even though we had a manufacturing recession up in here and tough time with commodities and things. But the overall general state of conditions was okay, so we stayed growthy. And we came back in here, and when we were actually scoring our index, this is back testing it, but we were scoring it on a weekly basis. And right in here, I don't know how many videos I did showing you the history, showing you how the technicians, or a lot of them, were rolling over and going bearish because of the charts. We stayed bullish because of general conditions. And then lo and behold, up in here, we started getting bearish while the market was continuing to scream higher because general conditions, our overall assessment said the risk reward setup no longer makes sense to play in this market the way we did all these years leading up to it. So my point today, folks, is here we are, big decline. That 200-day moving average falls right on about 3,000 on the S&P, and we are at 2930 right here. So we'll see. So this, from a technical perspective, is going to be some serious resistance. One more thing, and then I promise I'm going to finish up. So this just kind of brings home this last part of my presentation this morning. And these are the back tests. We didn't do one for every week, but we did one at key points. I already mentioned this European debt crisis. We still were green. At the time, we weren't scoring an index, but we stayed growthy, stayed growthy, stayed growthy, got defensive. Here we are, still defensive. Today's score, negative 74, just shy of our worst ever score, which happened last week, which was rounded to a negative 76. So, folks, well, I'll say this. Folks, this has us, certainly has me, bolted to my chair pretty much all day long and too far into the evenings in most cases. But that's what this kind of market demands. If you haven't read the book Blink, you might like it. I'm listening to it as I take some time to work out or what have you. There's a chapter in there that's a story about a war game that the U.S. played. Fascinating. But as I was listening to this, I began thinking analogous terms, and I was in my mind thinking about peacetime in the world and bull markets. Bull markets to me are kind of like peacetime, meaning things are pretty good. There's, you have your skirmishes, you have your little cold wars, you have your things, right, that create some stress and some strain. And maybe you make some adjustments and so forth just to make sure that you're protected, but you're at peace, right? And so at peace, you don't need to do a whole lot. Just, exercise, stay strong, run some drills, test what happens, play your war games during times like these. but it's pretty easy. Bull markets are easy to do. Bear markets are wartime, right? Bear markets, you have to have strong defenses. So right up in here, we basically saw that things were heating up under the surface. A lot of people didn't see that. A lot of people, in the consumer space and so forth, as we talked about ad nauseum, were just really thinking that peacetime was here and it was going to stay for a long time. Was not our assessment when we started turning red back in here. We said that, we don't know that a war is imminent, but we do know if somebody fires a shot, it's going to be all-out war. Or if something hits this market, it's going to be an all-out bear market. Well, of course, we know that. We know what the shot was. So here we are right now, folks. Metaphorically, we're at war. And at war, again, you hope to go in it with strong defenses. We'd like to think we have those, particularly with the hedges, and we did mix up the portfolios back up in here in December. But there's, landmines out there. There's, rocket fire that comes at you from different directions. So you have to stay flexible. You have to stay nimble. I know all of you have noticed just a plethora of trade confirmations from us as we do things. Slowed down a little bit of late. It slowed down a little bit of late because we think we're decently positioned for the next round, the next, bomb to be dropped. And so we will still tweak. We did a little tweaking about a week ago, not much this last week. But we'll go through these periods where we have to move, we have to change bunkers, we have to do these things to protect our troops so that we can make it through this war and survive and be in a position to be healthy, strong, lean, you name it, so that we can catch the next peacetime and make the most of it. But the key to success there is going to be to do well as this bear market unfolds. And so folks, I will leave it there. That was a long one. Thank you so much for hanging with me. Have a wonderful weekend. Be back soon. Bye-bye.